I'm going to ask for a little bit of mercy in this video. Please don't shoot the messenger. I'm just passing along what I think is some important information if you are an investor in North America. Right now, one of Canada's top economists, this is the Chief Economist, Senior Vice President at TD Bank Group, Beata Caranci. She is warning that a full-blown recession is not only a possibility, she says it's a likelihood and possibly already underway. The TSX, as you might know, just hit a record high, closing above 26,000 for the first time. That's definitely showing a lot of market optimism, but I think it might be missing some of the serious warning signs that are out there. Let's break it all down. I want to start with some basics here. TD Bank, BMO, National Bank, Deloitte, they're all forecasting negative GDP growth in the second and third quarters of 2025. If that happens, that would meet the traditional definition of a recession, 2 consecutive quarters of contraction. Now, that's not the official definition. If you want to learn more about how that's determined, I will put a link right here so you can look that up. But for the purposes of this video, here's what they're predicting. TD is saying negative 1% growth in Q2, negative 0.2% in Q3. BMO, negative 1% growth for both quarters. National Bank is saying negative 1.1% in Q2, negative 1% in Q3. Deloitte is saying negative 1% and negative 0.9. Now, there are some other banks, RBC, Scotiabank, they are remaining a little bit more optimistic and they're forecasting slower, but still positive growth. CIBC, they expect only one negative quarter. Now, according to Caranci, the key driver of Canada's downturn is a combination, rising tariffs, deteriorating sentiment, and ineffective policy tools. Currently, Canada's effective tariff rate with the US, that stands at about 12%, primarily due to the 25% duties on steel, aluminum, and non-USMCA compliant goods. TD forecasts that this may fall to 5% by the end of the year and by 2.5% by 2026 if a new trade deal is reached, but the damage may already be done. Caranci says, "We're very worried that we're going to be in a formal recession in the second and third quarters and that we can see perhaps another 100,000 jobs lost. More than 70,000 private sector jobs have vanished in 2 months. And even the housing market, this is a traditional Canadian economic engine that isn't responding as they'd like to the lower rates. And even though we have seen a 100 basis point cut from the Bank of Canada rate since November, 2.25% since June of last year, home sales have dropped 20% since those November cuts. The Bank of Canada, they are facing a major policy challenge here. Governor Tiff Macklem, he's acknowledged that there are limitations on interest rate cuts, especially in a supply-side shock environment like the one we're seeing right now. And he was speaking at the G7 meetings just last week in Banff, and he warned of weaker growth without a resolution to the tariff battle. TD Bank expects the Bank of Canada to cut rates just 2 more times in 2025, down to 2.25, but Caranci is warning that that might not be enough. She says that if a trade deal suddenly arrives, any aggressive cuts could risk overstimulating the housing market, and that would be similar to what happened during the pandemic. In other words, rate cuts might not work, and they could even go so far as to backfire. Now, I want to look at this from both sides. Not all economists agree that we are in recession territory. There are some, like Concordia University's economics professor Moshe Lander. He called this an economic slowdown. He argues that while growth is slow, it's not necessarily negative. Specifically, he says that doesn't necessarily require 2 consecutive quarters of declining GDP, just that we're not going to grow as fast as we could, should, or did. The stock market could soften, the housing market could soften, the labor market could soften. We could start to see more and more people caught up in financial distress because of job losses or that their income isn't growing as fast as it otherwise could or should. Now, to me, whether you label that as a recession or not, that sounds like a whole lot of bad news. Now, like Lander's York University Associate Economics Professor George Georgopoulos, he says, while I expect GDP growth to slow down in Canada over the second and third quarter, I do not expect negative GDP growth in either quarter. The environment now is more conciliatory and open to healthy discussion on reducing tariff rates. But again, Caranci, she is not quite as optimistic, and she sees more what she says systemic issues. And she describes Canada's current path as a wartime scale economic restructuring, simultaneously trying to reduce U.S. independence, to build domestic resilience, and to expand globally. Now, going back to the housing market issues I mentioned a minute ago, she says that the housing market, which has always been that sort of consistent engine of economic momentum, just hasn't responded to economic easing. In Ontario and BC, home prices are projected to fall 6% and 4% respectively in 2025, with the Ontario condo market potentially seeing a 15 to 20% drop from its peak. So where does all this leave us? Well, TD has revised its March projection for 2025 Canadian GDP that was previously forecast at 1.3%. That's now down to 0.8%, and now expects just over 1% growth in 2026. Now, as far as the U.S., Caranci is a little bit more optimistic there. She does expect growth of 1.5% in 2025, potentially hitting 2% in 2026. That is thanks to an anticipated resolution of trade tensions by Q3. So the big question is Canada heading into a recession? Clearly, according to Caranci, all signs are pointing to yes. We've got the trade tensions that are unresolved. We have mounting job losses. We have faltering housing, and consumer confidence is sagging, and Canada's economy, as she says, is on shaky ground. She does say, though, that if the trade deals are finalized, if policy execution improves, then the economy could rebound. The next few months are going to be critical. Now, what do you think? Are we facing a true recession or just a temporary slump? Love to hear your thoughts in the comments. I would like to thank Harvest ETFs for supporting this video. We're talking a lot about market uncertainty in this video that has a lot of investors looking for stability without giving up on the long-term growth. And that is where the Harvest Low Volatility Canadian Equity ETF, HVOL is the ticker, comes in. HVOL, this fund is built for resilience. It focuses on long-term capital growth by investing in 40 high-quality Canadian companies selected through a disciplined, rules-based strategy that prioritizes lower volatility. So it is designed to smooth out the ride, especially when the markets get bumpy. Now, for investors who are looking to generate extra monthly income on top of that stability, there's HVOI. This is the Harvest Low Volatility Canadian Equity Income ETF. And this builds on HVOL's core strategy, but it adds an active option overlay to deliver enhanced cash flow every single month. Both of these funds aim to limit exposure to market shocks, to reduce individual stock risk, and to provide a more comfortable investing experience, especially for those who are approaching retirement or anyone who just wants to sleep better at night when they're investing. Now, in unpredictable times like this, confidence does matter. You can learn more about HVOL and HVOI at harvestetfs.com and see how lower volatility doesn't mean lower potential. Now, moving on to the debt problem here in Canada. A new Equifax report just came out, says more Canadians are falling behind on debt as we're seeing growing economic uncertainty. 1 in 22 consumers, about 1.4 million people, missed at least one credit card payment in early 2025, even though credit card spending is actually down by $107 per person. Now, Rebecca Oakes, she's from Equifax Canada, she says, in order for anybody to kind of keep making the payments, you need to have an income, you need to have good employment. When there's economic uncertainty, that does create a few impacts. High living costs, rising unemployment, and trade tensions are making that harder. Delinquency rates for non-mortgage holders, they rose to 8.9% compared to 6.5% for those with mortgages. The average non-mortgage debt hit $21,859. That was pushed up by car loans as people are trying to beat possible hikes there. Now, younger Canadians, they're struggling the most. That has been a perennial problem that we have here in Canada. Their credit card delinquency rate jumped 21.7% to 5.38% year over year. And Ontario saw the highest financial stress. The average 90-day mortgage delinquency rate there, 0.24%. Non-mortgage delinquencies up 24%. As was predicted, the mortgage renewals that we're seeing now at higher rates, that's adding to the pressure, especially for those who locked in at those much lower rates during the pandemic. Last story for today, a U.S. court has said that President Trump went too far when he used the emergency powers to put tariffs on countries like Canada, China, and Mexico. No, those weren't the tariffs on steel or cars. Those are still in place. But this decision, it's about a different set that Trump rolled out on April 2nd, the day he called Liberation Day. The court says that those are illegal. What is Trump's argument here? He claimed that America's trade deficit and the opioid crisis, specifically fentanyl, were emergencies, and that gave him the power to act. But the court didn't buy that story. They said that emergency powers don't give the president unlimited controls. Now, the law that Trump used, the IEEPA, the International Emergency Economic Powers Act, this is a U.S. law that passed back in 1977. It gives the president special powers to deal with unusual or extraordinary threats from foreign sources, but only during a declared national emergency. It is meant for sort of real, clear-cut foreign threats, not, as they're calling it now, this sort of general trade drama. Tariffs, in this case, had nothing to do with stopping drugs. This case is part of a bigger push to take trade power away from the White House and to put it back into Congress where it legally belongs. Now, Oregon Senator Ron Wyden, he's a top Democrat on the Senate Finance Committee. He says, "I'm committed to retaking Congress's authority over trade for good and shutting down Trump's ability to unilaterally declare trade war with the world." The White House, they predictably fired back and they said that judges shouldn't be deciding how to handle national emergencies. But this court made it clear. They said that the president can't just declare an emergency and start a trade war without following the real rules. If you found today's video helpful, please be sure to like, subscribe for more economic deep dives. As always, I say thank you for watching. We'll see you in the next video.